This week on 23rd May, we have 4 webinars lined up for you. By 10 a.m., we have 2 webinars. If not mutual funds, then how will you reach one floor? And India's new convenience economy, how urban company Digitised home services. By 11 a.m., we have Are you doing your SIP right? Decoding the winning SIP strategy. By 12 p.m., we have the right way to split one floor across assets in 2026. Links for these webinars are given in description. Do join and make your weekend a learning weekend.
How do I see this market? This year, we have seen the FIIs sell close to 1.75 lakh crores worth of Indian equities. If you look at the headline statistics, you'll probably see that the DII figure for the same period will be a matching net investment figure. Broadly, the DIIs would have bought for as much as the FIIs have sold. But look closer and the story turns. The FIIs have been selling large cap companies predominantly. Their selling in the mid cap space has been selective, and FIIs don't own too much in the small cap space that can be sold. The DIIs, on the other hand, have been investing heavily in the small cap and the mid cap space. Their investments in the large cap space is only a fraction of how much FIIs have sold in the same large cap space. That explains the weakness and the sustained fall in the large index heavyweights. So it's probably the insurance companies or maybe retail investors who are actually absorbing the sale of large cap blue chip companies by the FIIs. So the money may be actually coming from the platforms and going to the FIIs. The DII money, on the other hand, is only doing a prop-up job of valuations in the small cap space because DIIs continue to buy the same stocks they own, and this continuous buying of the same stocks which are already in a portfolio prevent those stocks from falling, and when the market falls, DIIs buy more of these same stocks and prop up these stocks once again. So though you look at a market where the DIIs and FIIs are making matching contributions of selling and buying, this market clearly lacks the balance that can give it stability. In my assessment, most of the DII investing that is happening today is probably going to seed future instability in the market if the macros continue to remain weak. Now, what are the weak macros telling us? First, the rupee is under very severe pressure because the FIIs have sold in roughly 17 months for 3.7 lakh crores, of which 2 lakh crores is in the last 5 months. We could see some more selling for a few months, after which I think the selling momentum will gradually peter out. This could see very testing times for the rupee unless we are able to shore up the sentiment on the rupee quickly. We have done it before. We have done it against much higher odds, but we still need to do it now in good time. Two of the biggest worries for India are soaring oil prices and high gold prices. We continue to mindlessly import gold, and we cannot do anything about our oil needs for at least a few more years. We would need to import more because our energy needs are growing continuously. Without energy, it would be very difficult for us to power our economy even to the 6% revised GDP growth rate that is being spoken about. So, our energy security comes at a very heavy cost because of the Iran war. And that in turn will continue to keep the pressure high on the rupee. So, unless the Iran war comes to a quick close or oil prices come down and stay down, maybe closer to $80, we are heading for a period of much higher pain than we anticipate. This explains that speech by the PM the other day, where he touched upon various points. We are looking at a 10 rupee hike in petrol and a 5 rupee hike in fuel, and this hike may need to be repeated for at least a couple of months. Clearly, that will have an inflationary effect on the economy, and we are also staring at a prospect of a super El Nino year, and if the rains don't hit our coast in the next week or so, we will see the market gripped by fears of a weaker monsoon. So, the rains have to hit our coast on time, maybe in late May, and then move without stalling towards the hinterland over June and July. So, the pressures on the stock market are going to be very high for the next 90 days. A very swift end to the war and a complete opening up of the Strait of Hormuz can definitely soften the pressure. Swift action in the forex market to cool the rupee down and give confidence in the rupee can also significantly change sentiment. I believe that an interest rate hike is inevitable. So, a quick reset of interest rate can also take away the uncertainty related to that event. So, essentially, this market needs event related uncertainties to unwind one by one or to be put behind one by one. Sequentially, as these uncertainties are put behind, I believe this market would stabilize, and that would probably set the stage for FIIs to take a fresh look at India. In the meantime, India would need to ensure that the big FDI commitments in data centers come into the country. The dollars need to come in quickly, and more long-term capital needs to come into the country in the rest of this calendar year. If we are to bring in FDI of maybe 4-5 lakh crores very quickly over the next maybe 12 to 18 months, I would think that we would see a very different rupee. Today, it feels almost like how it felt in 2012 when the rupee was 67, going up by a very steep 50% within a very short span of time. Today, we haven't gone up by 50% on the dollar over the rupee, but it still feels the same because the impact on the economy is much higher because we are rising from a much higher base in valuation. The fundamentals of our economy are heavily dependent on how we manage our exchange rate, how we manage our interest rates, how we manage our inflation, and how we manage FDI. These four things are extremely critical. So, we need to first fix how we manage our FDI, and by fixing how we manage our FDI, we need to ensure that the risks on the interest rate and on inflation are somewhat kept in check or at least moderated, and we need to manage our domestic economy much better. Clearly, I see more reforms coming in the rest of this calendar year. These reforms would be very, very game changing and will have long term impact on the economy. But the short term impact of what we are staring at definitely needs to be dealt with caution. I believe the market is not positioning itself for these risks becoming bigger risks, in the sense that things getting worse is not factored in by the market. The market has coolly assumed that things will only get better and cannot get any worse. I feel this is a very reductionist thinking where risk management seems to be given less importance by the market. In my experience, whenever we give less importance to risk management, we get punished brutally. And that, in my opinion, is my biggest worry at this point in time. I'm sure the government can shore up the sentiment on the rupee. I'm sure the government can keep the damage on the interest rates somewhat in check and then improve the situation. It's quite likely that India would be able to overcome the super El Nino without too much damage. All that is possible. But managing investor behavior is not a government's job. It's the investor's job to improve his behavior in difficult times like the present. I feel that investors need to work a lot harder to improve their behavior. The last 5 years have made the investor far more complacent than ever before in our history. We are kind of taking a gaming approach to investing, which I think can come with a very heavy cost. It's time investors abandon this gaming approach to investing, become far more disciplined in valuation, avoid taking momentum for granted, and respect capital. This is a time when investors should respect risk and capital much more than we did in the last 5 years. Thank you for watching this video.